Good morning and welcome to this Thursday, September 2nd, Small Business Digital Academy session. My name is Faith Ritchie and I am filling in for usual host Robert Theobald. As always, at the start of these presentations, we always like to acknowledge and give thanks to our many community partners who have made all of this expert information possible for us to share. If you are new to the Small Business Bootcamp, this program was designed to help small businesses of less than 20 employees return from the COVID crisis stronger than ever. It is a statewide initiative and also includes our resource collective and content library. Our resources collective are additional tools, guides, and resources provided to us by our extensive network. These include strategies and tips for marketing, as well as efficiency for running your business. Our small business content library is a collection of our previously recorded sessions. We now have nearly over 180 recorded sessions, all of varying topics and expert presenters. So whether you are wanting to learn more about a topic or revisit a session that you got a lot from, those recordings are available on our website. For some reminders, for all up-to-date COVID mitigation measures and resources, we recommend that you visit the arizonatogether.org website and also the Arizona Commerce COVID-19 website, both on the screen. Additional programs available by the Arizona Commerce Authority include services to help you start, operate, and grow your small business. From small business services to the Arizona at Work to the Arizona Manufacturing Extension Partnership, there are programs and resources available for you and your business. In addition to those program resources, I also want to shed a light on our small business checklist. This checklist is an interactive and intuitive online resource to assist small businesses identify those commonly requested licensing information for local, state, and federal levels. Again, emphasizing that whether you're ready to start or more to learn more to operate or grow your small business, there are information and resources available to you through the Arizona Commerce Authority. Also, some small business updates, and I will post these links in the chat in just a moment. But first and foremost, I know your usual host, Robert Theobald, has been talking about this topic. And so I want to emphasize this again. PPP forgiveness is available. We were talking earlier on this call, and I was shared a statistic earlier today that according to the August 15th metric, small businesses with loans of $50,000 or less have an application rate of only 44.4%. So what does that mean for you? That means that over half of small businesses with 50,000 or less of loans have not applied for forgiveness. We will be sharing those links so you can learn more about the forgiveness process. We have also hosted some bootcamp sessions regarding this process, and those are also available on our website. In addition to PPP forgiveness, also want to bring attention to the new Back to Work Small Business Hiring and Retention Program. This is a new grant program allowing small businesses up to $10,000 in expenditures for employee hiring and retention efforts. We just did a special session about this program last week. Again, that recording is available for you on our website, and we'll be sharing that informational link in the chat in just a moment. The last two I would like to bring attention to is why we are here today, the Employee Retention Credit. It is a great resource for you to check out, and we will learn more about it in just a moment. But also, last but certainly not least, want to give a shout out to our small business development centers. They are throughout the state and can offer you direct one-on-one counseling and assistance through these processes and updates that we've shared, but also additional assistance in starting, operating, and growing your Arizona business. We have some fantastic sessions coming up and scheduled throughout this month of September. We encourage you to register for those sessions. They will be taking place at their usual times, Tuesdays and Thursdays at 9 a.m. As you can see, for our upcoming weeks, we have different topics and speakers joining us. So whether you are looking to improve your brand, include video in your marketing, or get better search engine optimization from YouTube, we have those resources available for you. So please be sure to check out our website and register for those sessions. Now I'd like to turn over the time to Carrie Ann Todd, who has offered her time and expertise to us a few times, but we are so happy to have her back to talk about the Employee Retention Credit. If you have questions for Carrie Ann before I turn my time over to her, please make sure that you are posting those questions in the Q&A box. We anticipate quite a few questions, and we don't want your question lost in the chat. So please, if you are hoping to get your question answered, please put it in the Q&A. So I will go ahead and stop sharing my screen, and Carrie Ann, I will turn the time over to you.
All right, thank you, Faith. And thanks to the Arizona Commerce Authority for this program and everything they're doing for small businesses. If you go back and look, she said there's 180 webcasts or webinars that you can go back and view. If you're a small business person, you're just starting, you've been going forever, there is something out there for you. I mean, the resources they're offering at the bargain price of $0 are amazing. So take advantage of that. Okay, so I don't really know how I got here to being the expert on the Employee Retention Credit. My background as a CPA is as an auditor. I spend most of my time auditing benefit plans. But when the pandemic hit and the CARES Act came out, there was a frenzy, and in our office, there was a frenzy to learn everything we could about these programs so that we could help our clients. And so I got looped into the group, and over the last 18 months, I've spent a ton of time on the PPP. And then in December, when the law changed and the ERC became the hot topic, I'm not really sure how it happened, but I got sucked into that. So I'm not a tax person, which is funny to me because all we're going to talk about is taxes today. But trust me, we've done all the research. The resources we're giving you is great information. And I'll be happy to answer as many questions as I can. So here's an outline of what we're going to go over. The majority of this session will be Employee Retention Credit, I promise, but there's, 4 other things that are out there for small businesses that I wanted to just quickly draw your attention to while you're still fresh. And we'll go through those real quick, and then we'll jump into the Employee Retention Credit. All right, the Work Opportunity Tax Credit. This is not new. This has literally been around forever. I remember talking about the Work Opportunity Tax Credit like almost 20 years ago, it seems like. So, but it keeps having a sunset provision, and then it'll get renewed. So in December, it got renewed through December 31st of 2025. It is a federal income tax credit, meaning you take it on your income tax return, available to employers for hiring individuals in targeted groups. Here's the list of targeted groups. Veterans, summer youth. I mean, there's all of these different categories. Like I said, we're not going to deep dive into these. I'm just giving you the information, and you'll have this information in your slides that you can go back to later. If you go to this website, you will find this list, and you can click on every plus next to the word, and it'll tell you the details of who exactly qualifies as an ex-felon, who qualifies as a SNAP recipient, because they all have very specific qualifications. So you can look at all those different categories. And if you hire someone in one of those categories and meet the requirements, you can get a tax credit between $1,200 and $9,600 per employee. The credit is different based on the category. Some of the credits are a single year, some of the credits are multiple year. You cannot use the same wages for this that you would use for the ERC or the PPP, or, since we're rattling off acronyms, the SVOG or the RRF. The SVOG is the Shuttered Venue Operators Grant, and the RRF is the Restaurant Relief Fund. So all of these are government programs, all of them kind of targeted at wages. And the moral of the story is you can't double dip. You can't use the same wages for all the programs. So you just have to keep them all straight. All right, can tax exempt employers take the work opportunity tax credit, right? Because this is a federal income tax credit. Tax exempt employers don't pay taxes. The answer is yes. They just file a different form. The form is listed here. So if you're interested in that, definitely do the research if you're interested in hiring people in those targeted groups. Okay, the next topic is research and development tax credits. Again, this is not new, but what I will say is that the definition of this is very broad, and the longer it's been around, I feel like the more broad the definition gets. If you, in your brain, when you hear the word research and development, you think of, let's use a current example, a pharmaceutical company developing a vaccine, right? A vaccine that's never been around before for a new problem. That's what you think of when you think of traditional R&D. The definition in terms of this tax credit is extremely broad. It could be something like, I have a client who is in the sporting goods manufacturing sector, and they have a product that they sell, and they've been selling this product in its various forms since the 70s. Okay, every year they're working to make that better. Right? They make this do that better, or this faster, or whatever. I can't tell you all the things, but those things qualify as R&D under this definition. So if you have an existing product and you're just working to make it better, the time and materials that go into making that better could easily qualify for the research and development tax credit. It is a federal and an Arizona program. So it's something you could get income tax credits for in your federal return and your Arizona return. Like I said, it does not have to be revolutionary. There's no company that's too small. There's no company that's too big. The documentation standard is low. Like, how do you capture all that data? As an auditor, it makes me cringe when they say you don't have to do a lot of documentation, because that just, it goes against my grain. But it's essentially, you would come up with a methodology that says, okay, these people spent these amount of hours, here's their rate, here's their benefits, here's the supplies we use. This was the cost of making this product better, or making this process better, or creating this software to make it better, whatever. You just identify that cost, and that's the foundation of what the credit is based on. What if you're a startup company, right? A lot of new businesses on this are startup companies. They don't pay income taxes yet because they're not making any taxable income. So if you're a startup company, there's an option to take the R&D credit against your payroll taxes in the first 5 years of your business. There are restrictions on that. You can't have gross receipts over, it's either $500,000 or $1 million. And like I said before, the credit is based on payroll, supplies, and certain other costs that you can identify as directly related to these R&D activities. How do you figure out if you're going to qualify? This one, I would definitely recommend a CPA. I glossed over the rules yesterday. They're super technical. And you would really want someone to help you that has experience, work through all the what ifs and all that to figure out whether you qualify and what expenses might qualify. So if you don't have a CPA and you think you might take advantage of this, you really need to get one. And make sure they have experience with R&D tax credits before you engage them as your CPA. Okay, this one is a retirement plan startup costs tax credit. If you have a business and you're going to form a new retirement plan, a SEP, a simple 401k, excuse me, there's lots of choices, and you have less than 100 employees and you don't already have a retirement plan, you're starting one from scratch, this credit may be available to you. The terminology here on how the credit works is you have to understand a little bit about retirement plans. So if you're starting a new one, what I would say is make sure whoever prepares your tax return know that you started a retirement plan and have them advise you and help you through the process of figuring out what your credit is. It's going to be anywhere between $500 and $5,000. If you include an auto enroll feature in that retirement plan, you can get an additional $500. As a benefit plan auditor, I'll tell you that's a great idea, but let me tell you, it comes with a lot of paperwork. You got to be really prepared to stay on top of eligibility and make sure you're auto enrolling people as they come eligible, or you're going to give yourself more headaches. So that's free advice about benefit plans. The last one we're going to talk about before we hop into ERC is this deferred employer share of Social Security taxes. So the CARES Act included a provision that allowed you to defer the deposit and payment of the employer's share of Social Security taxes. That's the 6.2% of the FICA, right? FICA is made up of 6.2 of Social Security and 1.45 of Medicare. The provision allowed you to, for all your employer share of Social Security due between March 27th and December 31st of last year, you didn't have to pay it. You had to accrue it, right? Knowing you're eventually going to pay it, but you didn't have to actually deposit the money until this year. 50% is due by this December, and the other 50% is due by next December. There's been some recent interpretation on that I just want to share with you so you're aware. They are working on the process for how you actually pay that. When I went to copy this from the IRS website, I was surprised to see this because when I looked at it 3 weeks ago, there was a different answer under how to repay the deferred taxes. So they're still working, excuse me, they're still working through that process, but you will in general pay it through the EFTPS program. And you'll have to designate in there that you're paying the deferred taxes so that it doesn't get credited wrong in your account. The second thing I want to draw your attention to, and there's a ton of FAQ out there if you go to the IRS website, you do not want to be late. You do not want to miss your deadline, and you want to pay everything that's due. So if you owe 50%, pay at least 50%. And please do not pay after December 31st, your first 50% installment. Why? If you either short the first installment or you make it late, you pay it late, either the first one or the second one, there's going to be a 10% penalty. So now not only do you owe the taxes, right, you're going to owe a 10% penalty. So I wanted to get that information out there because that's kind of new. And the penalty is going to be based on the total amount deferred. So if you deferred $20,000 and you were late on one installment, $10,000, the penalty is going to be based on the full 20. It doesn't matter. So anyway, those penalty abatement rules, you could get it abated if there's extenuating circumstances, but everyone's known these are due since last year. So I wouldn't expect a lot of grace from the IRS on this one. Let's see, if you miss both deadlines or you don't pay half on the first deadline, again, you have to be paid penalties on the whole deferral. And the IRS is going to send you a demand letter. And if you don't pay within 10 days, they're authorized to increase the penalty to 15%, from 10 to 15. So there's just, it could cost you a lot of money if you don't pay, if you deferred and you don't pay those timely. So I just wanted to kind of give you a heads up. Okay, takeaway, pay it early, right? Pay it December 15th. That way you don't have to worry about it. Okay, let's jump into the employer retention credit. Fair warning, this is really technical. There's a lot of rules. There's a lot of math. You've probably heard the saying, how do you eat an elephant? Yeah, one bite at a time. That's kind of how I view the employee retention credit. It's a lot of information. It's a lot of calculations. If you just break it down and look at it piece by piece by piece, you can get there. And that's what these slides do for you. There's about 70 slides in this topic. I have 30 minutes and change to go through them. That's 30 seconds per slide. Probably not going to do that. I might skip over some and try to keep this high level, but all of these slides are in the PDF that Faith either already sent out or Lisa already sent out, or that you will receive after this presentation. So you're going to have these slides later. So please don't get rattled if I go too fast. Because, it kind of is what it is. Okay, so the ERC, just a little history, was established by the CARES Act. That was March 27th, 26th, 2020. Under the original CARES Act, if you got a PPP loan, you could not take the ERC. Okay, and so the ERC was viewed as a comparable benefit for a company who either was ineligible for PPP or unable to get PPP funding. If you remember, round one of last year's PPP funding went really fast, right? Everyone was nervous. They came back through and they put more money into the program. So there was a second window and most everyone who wanted it got one. But companies that didn't, they could use the ERC for the most part. In December, the Consolidated Appropriations Act did two things. It removed the prohibition against anyone who got a PPP loan from also taking the ERC. And then it extended the ERC through June 30th of 2021. And with that extension was a slight change to the rules. Okay, so the rules for the 2021 credit are slightly different than the 2020 credit. Then along came the ARPA in March. And what that did is it kind of modified and added some more businesses to eligibility. It extended the ERC through the end of this year. And it extended the statute of limitations for IRS assessment from 3 to 5. What does that mean? The normal statute of limitations on a payroll tax credit on your payroll tax 941s is 3 years. This gives, I don't think it gives us 5 years to file amended. It gives the IRS 5 years to review them and make sure they agree. A recovery startup business is a new category that was added in March. It's for a business that started after February 15th. All of the CARES Act provisions were initially specific to businesses that were already in place and operating February 15th, 2020, with the idea that those were the businesses that were harmed. So anybody who started a business during the pandemic was kind of left out. So when they added this recovery startup business, it was an attempt to bring in those of you who started a business after February 15th and tried to make a go of it during the pandemic and give some benefits to you as well. So those are the kind of the rules on a recovery startup business. Then in August, like a month ago, the IRS issued a notice that kind of clarified a few things with the ERC that were very unclear. The first thing they did is says that tips are eligible wages. If you're a restaurant, you qualify for ERC. Which year and what periods is for debate, but restaurants were shut down. So that's kind of an easy in. And the question was, are tips eligible? Because technically tips are not paid by the employer, right? Tips are paid by the customer and then reported on the employee's W-2. So this notice clarified that tips are eligible wages, cash tips in excess of $20. The second thing it said is that wages paid to more than 50% owners and their spouses are ineligible. So that's kind of a big impact for a small business, especially where the owner and potentially their spouse work in the business and they probably have the highest payroll, but they're not eligible for the ERC. And logically, it makes sense, right? Should you get a tax credit for continuing to pay yourself? Maybe not. The third item they did was they specified that, this is my favorite, the wage deduction reduction on the company tax return is tied to the year the wages were paid. Okay, so if you calculate an employee retention credit and you file for that and it's $10,000, you have to reduce your wage expense deduction on your tax return for that year. So you can't get the credit and deduct the wages, is basically what they're saying. And even if you file for a retroactive claim for 2020, which a lot of my clients are doing right now, let's say you're going to file that today and you're going to get your money in, who knows, 2022. That's kind of irrelevant. If you're filing an ERC claim for 2020, that reduction, if it goes on your 2020 tax return, which many of you may have already filed. So filing a retroactive claim may also come with amended tax returns. That's something to keep in mind. And then the last thing they clarified is for the gross receipts test, which we're going to talk about, PPP forgiveness, SVOG grants, and RRF grants are excluded from gross receipts. And that was a significant interpretation because those are big dollars that companies are receiving, and it could really skew their gross receipts. So that clarity was extremely helpful. Okay, the current legislation is out there called the infrastructure bill. If you Google it, Google the infrastructure bill, that's the one that's out there. And it currently includes a sunset provision on the ERC. It would no longer be available for Q4 of 2021. So right now, under existing law, the ERC goes through 12/31 of 2021. The infrastructure bill, if passed, would cut it off at September 30th of 2021. So keep your eye on that. I haven't seen any indication that your ability to file a retroactive claim is going to be affected by the legislation. They're just putting a sunset provision on it. Okay, so what is the ERC? The ERC is computed using eligible wages and allocable healthcare costs, okay? Eligible wages is usually gross wages paid during the relevant period. Allocable healthcare costs are costs for insurance related to the relevant period. And so the reason they say allocable is because, as you know, healthcare premiums are probably paid once a month, right? So you might pay on March 27th for the month of April. So by using the word, excuse me, allocable, they're not saying it's just healthcare costs paid during this period. It's what's allocated. So if you're eligible for the month of April, it's healthcare costs attributable to the month of April, okay, regardless of when you paid them, if you paid your bill in March or you paid your bill in May. So that's what allocable means. So right now the credit is available in 2020 for wages paid from March 12th to December 31st, and then all of 2021. Like I mentioned earlier, the eligibility and credit computations are slightly different for 2020 and 2021. So we're going to address each year separately. And I'm going to slow down a little bit. It's already 11:30. I'm going to go through 2020 really as slow as I can. And then 2021 we'll go through a little faster because I will just highlight what changed. Okay. So this is 2020. So until you see another blue slide like this, we're talking about 2020. I try to put 2020 at the top of every slide so you know which year we're talking about. So there's two different ways you can be eligible for the employee retention credit. The number one is a full or partial suspension of operations. And I have two examples we're going to go through on that. So let me just go through the examples first, and then we'll come back to the second bullet point. So here's the details on the partial shutdown. That means you had non-essential operations that represented more than 10% of your revenue in 2019. And your eligibility period is limited to the time frame in which you were partially or fully shut down. So what does that mean? Let's talk about it in terms of two industries that make a lot of sense logically for everyone. So a restaurant that is primarily a dine-in operation, casual dining, not necessarily fast food, but you could probably go that direction, is limited by an executive order from Governor Ducey for only takeout on March 20th. On May 11th, they said, okay, now you can have dine-in, but it was restricted to 50%. And that restriction stayed in place through actually March 6th of 2021. But definitely through December 31st. And this is someone everyone kind of understands, right? Because we all saw that. It was in the news. We saw it at our local restaurants. Under the rules for ERC, this restaurant is deemed to have essential operations and non-essential operations. The essential operations is the takeout. And the reason it's essential is because the government allowed it to continue. They deemed it essential to the economy. The non-essential was the dine-in, because that was initially shut off completely and then secondarily restricted to 50%. So for this restaurant, they had to prove that their dine-in operations represented more than 10% of revenues in 2019. If that was true, this restaurant experienced a partial shutdown from March 20th through December 31st of 2020. Okay, so that's the application of a partial shutdown rule to a restaurant. So let's talk about another one that is a little different, that kind of will give a little more insight, and that's a dentist. So think of your traditional dentist, not a specialist, just the one you go to get your teeth cleaned. Dentists were limited by an executive order from the governor last year. They could only perform emergency services starting on March 21st. And then later, a government order came out and said, starting May 1st, I believe, you can now resume all your services as long as everyone wears the proper PPE, you do all these cleaning, there's social distancing in your lobby, and all of these things are put into place. So this dentist looked back at their 2019 records, and they determined that their non-emergency services, which for traditional dentists would be cleanings and preventive care, represented over 40% of their revenues. Okay, so under the rules, they were deemed to have essential operations, the emergency services, and the non-essential operations, the routine operations. So because they met all the requirements, they had an eligible partial shutdown from March 21st through April 30th. Okay, so only wages and allocable healthcare costs for this dentist from March 21st through April 30th are eligible for the ERC. They're not eligible for the whole quarter. They're not eligible for the whole year. They are only eligible for the period that they were specifically shut down. Okay, so I want to make sure that's clear on the partial shutdown rule. Okay, the second bullet we'll pop back here talks about a decline in gross receipts. Okay, and you're eligible if you meet one or the other. See the or here, this is not an and. You didn't have to be shut down and lose revenue. You were either shut down or you lost revenue. So I have some slides on the gross receipts that we're going to talk about more specifically. On the gross receipts test for 2020, you're going to have to look at your 2020 and 2019 gross receipts by calendar quarter. The rule is very specific. You have to use calendar quarter. The reason is ultimately this is a payroll tax credit. Payroll tax reports are filed quarterly, calendar quarterly. And so everything is tied to calendar quarters on the ERC. So in what accounting method you use, the accounting method you use internally, whatever you have that you keep your internal records on, or your income tax method of accounting for the same. But anyway, so here's an example of the math. For 2020, you meet the gross receipts test if you had one or more quarters where your gross receipts were less than 50% of what they were in 2019. Okay. So in my example here, and I hope you can see my mouse, but you can see in this example, Q2 had $60,000 of revenue. And in 2019, it only had $25,000 of revenue. So 2020 is 42% of 2019. That's below 50. So this business is eligible for the second quarter. You stay eligible until the quarter after your gross receipts go over 80%. So over here on the example 2, I have an example of how that works. So the same data for Q2, they're at 42%, but things started to pick up in Q3 and they were at 83%. So they're still eligible for Q3, but they're not going to be eligible for Q4 because they went over 80% in Q3. So the moral of the story is for 2020, if you're eligible for one quarter, you're going to automatically be eligible for two, which is great because it makes, it makes it easier to get the maximum credit. It also gives you more flexibility if you have a PPP loan to kind of manage those two things. But anyway, so that's how the gross receipts test. So that's the first thing you have to look at. Did you have a partial shutdown, or do you meet the gross receipts test? The second thing is now you got to figure out how many employees you had in 2019 in order to determine which category of the credit you fall under. Okay, so this is step 2. You're going to look at the number of full-time employees you had in 2019, and you have to do math. You know, it's exciting. And you only include employees who average more than 30 hours a week or 130 hours a month. This is not a full-time equivalent computation like you did for PPP. This is old school full-time employees. You either are one or you are not one. And I've got some examples here. So let's go straight to the 30 hours a week test. Basically, you could make a list. You could take data for your employees, figure out their average hours per week. And you can see I've got Adam Ant here. He averages 35 hours a week. So he's a 1. I've got Marco Brown. There's some weeks he's over 30 and other weeks he's under 30. His average is 29.75. He's a 0, okay? He is not a full-time employee, so you do not count him. Same with Ruby Castro. She's obviously part-time. She doesn't get counted. That's how you apply the math. Then you have to do it by month. Okay, so you got to do that same math for all of your employees for every month. Take the result, add it all together, divide by 12. That's your average. So when it says compute the number of average full-time employees you had in 2019, this is the math they're asking you to go through. If you have multiple businesses with similar ownership, you have to aggregate, okay? Each business is not going to stand on its own here. They look at all of your businesses as one for purposes of this credit, okay? Same with the gross receipts test. If you have multiple businesses, you have to fill out that gross receipts analysis, adding up all your businesses together, okay? You can't look at them in isolation. So now what? You have your number. What do you do with that number? Okay, if the number is 100 or less, then you get the most credit. You can take all wages and healthcare costs paid during the affected period or quarter minus any FFCRA wages. Talk about that in a minute. So what that means is if in the dentist example, let's say he had 10 employees. He can take the wages on all 10 of those employees and their health benefits during that eligible period of 6 weeks. Let's say that dentist has 150 employees. For 2020, that dentist now can only take the credit on wages and healthcare costs paid to or for employees who are not working. So there were some companies that in the early stages of the pandemic literally paid their employees. Okay, that's the kind of people we're talking about here. They were not doing anything for their employer. They were not working from home on their computer. They were waking up every day and, you know, not doing much for the employer. That's who we're talking about here. For companies that have more than 100 employees in that analysis of 2019, you're only eligible for people you paid to stay home and not work. Okay, so that's the second. You have to do the math in step 2 to figure out which category here that you fall into. All right, and now I know you're excited, but there's more math to do. So now you figured out whether you're eligible, you figured out which category you fall into. Now you actually have to calculate the credit, right? So in general, the credit is the first 50% of the first 10,000 wages and applicable healthcare costs paid during the affected period, whatever that period is for you, whether it's a whole quarter, 2 quarters, a small 6-week window, whatever that is. The maximum credit, excuse me, for 2020 is $5,000 per employee. Okay, now there's 4 things you have to consider, of course, that are additional restrictions beyond what we've learned so far. Okay, the first one is this. I talked about it earlier. You can't double dip. I'm reminding you, you can't double dip. So if you took the sick or family leave under FFCRA cares, wages that are not eligible. Any wages you claim for the work opportunity credit are not eligible, RRF, and the PPP, but I've got a separate slide on that. So you can't double dip all these government programs, or in this case, triple and quadruple dip. Restriction number 2, can't pay your relatives and take the credit on your relatives. So the list of relatives here is, it's basically everyone, is what I've decided. It's everyone except your ex-spouse and your ex-in-laws. I think everyone else that's potentially related to you is on this list. And this list applies to any owner who is more than 50% owner. Okay, so if you only own 25% of the company, this list, you can hire and pay your employees or your relatives. If you're more than 50% owner of the company, then you are restricted on taking the credit on your relatives that work for you. Restriction number 3, you cannot double dip on ERC and PPP. So if you're looking at 2020 right now, and you've already filed for forgiveness, which I really hope you have, because otherwise you're gonna have to start making payments on that loan or pay it back. You cannot use any wages you used on your PPP application for the ERC. Okay, now that's kind of a broad statement, because if you dig into the nitty gritty, depending on how you filled out your PPP application, that you may be able to reallocate some wages off that application and use them for ERC, but those rules are extremely nitty gritty. And if you're going to go that route, I suggest you hire a CPA to help you out, just to kind of wade through all those rules. Okay, so you can still go back and claim it for 2020. But if you had a PPP loan in play, you have to be really careful about the wages and the periods and making sure you're not using the same wages twice. Okay, restriction number 4, I've mentioned it already, the aggregation rules. Okay, so all throughout this process, you have to factor in businesses that have common ownership. You know, one person owns 4 companies, or 2 people own multiple companies. You kind of have to go through these aggregation rules to figure out who has to be aggregated. But once you determine that you do have a group of businesses that have to be aggregated, you have to apply that for the gross receipts test, the employee count test. And then also when you're calculating one person that works for 2 different businesses, you cannot take 5,000 of credit in each business. It's 5,000 total for that one person. So it gets even more difficult when you have to aggregate, because there's just a lot more stuff to pay attention to. Okay, so here's an example. So let's say we get through all that and we're eligible, I did a calculation just for Q3, just to show you what that looks like. So I've got my employees here. We've got Fred, he's the owner, and Fred's daughter, Christy, works for the company. Okay, Fred's the only owner, so he's 100% owner. And so therefore he's out and his daughter's out. So you can see over here, we're calculating 0 eligible wages and 0 credit for Fred and Christy. Okay, everyone else, it's basically their wages minus their FFCRA, because those are not eligible, up to a maximum of 10,000. And I put the math down here on row 24, so you can kind of see how the math works out. But ultimately, you can't have more than 10,000 of eligible costs per person, because you can't have more than $5,000 of credit per person. Okay, so that's kind of an example of the actual math and how you would calculate it. You can see this person for 1 quarter for this business, excuse me, they have 10 employees, if I counted right. 2 of them are not eligible because it's the owner and his kid, and they still got a credit of $27,000 for 1 quarter. Okay, so it can be very lucrative even for a very small business. So now what do? I've got the credit calculated. You know, you've figured out what eligible wages are, you've figured out what your eligible health insurance costs are, and you know what the credit is. Now what do? Okay, you have to file an amended 941. This is a payroll. It's fully refundable, but it's not on your income tax return. It's on your payroll tax reports. So the instructions for the 941 are online. I'm going to be honest with you. If you look it up on YouTube, how do I prepare an amended 941 for ERC? You'll find at least 10 videos of very nice people that will explain to you how to do it. This part, once you get to here, this is like smooth sailing, because actually doing the 941X is not that difficult. All the other math you've had to do to get to this point is the hard part. Okay. So there's a worksheet you have to fill out. The worksheet is in the instructions. It breaks the credit into this non-refundable and refundable portion. Those are misleading because at the end of the day, whatever the credit is, that's going to be your refund. Okay. So in my example, this person is going to get a refund from the government of $27,039.83. Okay. Even though the form makes you go through these mechanics of breaking it down into refundable and non-refundable. There's a little more information on the ERC on our website if you're interested. The IRS has extensive FAQs on the ERC, 95, I believe, and they're broken up into categories. Just about every question you could probably think of is on there. They've done a pretty good job with their FAQs. So those are out there if you need them. Okay, so we're going to stop talking about 2020 and we're going to move over to 2021. Remember, I'm going to go fast because all I'm going to talk about is what changed for 2021, because 80% of the rules and the math and all that stuff is still the same. It's just there are slight tweaks for each little thing that we're going to go through. Okay, eligibility. The partial shutdown still in play. That rule is exactly the same. The gross receipts test is now only a 20% decline, but you still have to compare your gross receipts to 2019. Okay, 2019 is the base year. That's when everything was normal. So everything is still be compared back to 2019 as a reference. So it's not like everything slid a whole year. The base is still 2019. That's the same with PPP2. If you got a PPP2 loan, all of your base numbers are still those same original base numbers. Nothing slid on that. And then, like I mentioned earlier, we have this new category for 2021 called the recovery startup business. And there's a slide on that at the beginning. This is all still the same. Like I said, partial shutdown, all that rule is still the same. Recovery startup business, I'm going to skip over this, but if you think you might qualify, come back and look at this slide. So you'll know exactly how that might apply for you. In March, they also added this other category called severely financial distressed employer. That's someone whose decline in gross receipts is more than 90%. If your gross receipts decline more than 90% compared to 2019 and you're still in business, look into this, okay? Because they kind of loosened up the rules for you and made it a little easier to get that. So here's an example of the gross receipts test for 2021. Like I said, you only have to have a 20% reduction in revenue, and they have a look back rule. So in our example one here, in my Q1, my gross receipts are 70% of 2019, so I'm eligible. And in Q2, I'm at 75%, again, still below 80%, so I'm eligible. In my example over here to the right, you can see if I compare my Q1 of 2021 to Q1 of 2019, I'm actually at 90%. So on its own, the Q1 is not eligible, but there's a look back rule that says you can look back at the previous quarter. And if you're eligible when applying the rules to that quarter, then you're eligible for this quarter. So I know that's confusing. So what we've done is we said, okay, Q1, we're going to look back to Q4. So now we're going to compare Q4 2020 to Q4 2019. We're at 75%. That's below 80. So now Q1 of 2021 is eligible. Q4 is not eligible for 2020. Q1 of 2021 is eligible based on Q4. And then Q2, you would assess it individually also. And in this example, it's less than 80%, so it's eligible. If Q2 here, excuse me, was at 90%, it would not be eligible because it's not eligible on its own, and it's not eligible on the look back rule because when you look back to Q1 was at 90. Okay, so I hope that's as clear as mud. I know it's I hope you take these slides later and you go back through and read them and think them through. And if you want replay, you're glutton for punishment, you can replay the webinar later after you've done that. Again, how many employees you have is based on 2019. It's always the base year. So you're going to do all that same math for your number of employees, still same, still same, still same. But now the difference is if that number is 500 or less, you can use all the wages. So this is going to include probably everyone on this broadcast has probably less than 500 employees. So now, whatever quarter you're eligible or whatever period you're eligible, you get to include all the wages of all the employees, okay? Only those of you who are extremely large employers with more than 500, you can still take the credit, but again, it's literally paid to people you're paying to stay home and walk their dog and watch Netflix. In 2021, I don't know that that's happening anymore. So to me, that bullet point's kind of irrelevant. I think we're past that. What is the credit? Now it is 70% of the first 10,000 in wages. And it's applied at each quarter. Okay, so for 2020, it was 50% of 10,000, but a max of 10,000 for the whole year. 2021, it's each quarter is independent. So under the current law, which goes to the end of December, if you're eligible for every quarter and you have an employee who made more than 10,000 in every quarter, you could get $28,000 in credits for that employee. Okay. Now note, if the infrastructure bill passed, they're going to eliminate Q4. So this would be reduced down to 21,000. Still not too shabby, right? I mean, that's a lot of money. Regardless of your business size, $20,000 is a lot of money. Again, these restrictions are still the same. You can't double, triple, and quadruple dip on your wages. Wages paid to relatives are still out. PPP. Okay, so I don't think I can highlight. I wish I could highlight, but let's look at this last comment here in italics. If you got a PPP2 loan for the ERC in 2021, do not file for forgiveness on your PPP2 loan until after you calculate your ERC, okay? That allows you to maximize, right? It allows you to say, okay, I have all these wages in this period. What can I use for ERC? What can I use for PPP in order to maximize and get the most benefit for your business? So that's a heads up if you got a PPP2. PPP2 loans were, remember, issued in 2021. Okay, the aggregation rule is still in place. Very challenging. This is the same data as before, exact same data as before, except now we're at a 70% credit, right? So instead of 26,000, this employer is going to get 37,000 for one quarter because the rate increased to 70%. Same process. You claim it retroactively on an amended 941. If by chance you figure out you're eligible for the third quarter, we're in September. So the third quarter ends at the end of this month. Your 941 is due in October. If you determine that you're eligible and you were able to get it all done and get the math done, you could claim it on your original 941 that's due this October if you're eligible for Q3 of 2021. Okay. Everything else, looking back, 2020 and then the first 2 quarters of this year, you're going to have to do with an amended 941. Same about the worksheet. Okay, so I know that's really fast and I apologize for that, but I wanted to make sure we got through everything at least high level. You're kind of exposed to it. But I actually used to own this coffee mug and I don't know what happened to it, but this is kind of how I felt a lot right after I got out of college, and I'd have a really long day at work being a CPA and I would be just like, okay, I'm done. I need to go home, right? And it's only 10 o'clock where you are. So I really hope you don't feel the need to go home. But you know, you're not alone in feeling like this is a lot of information. All right, I'm gonna leave my slides up just in case any of the questions are helpful that I pop back through. So, okay, so I'm gonna go through the Q&A. How do we apply for the employer credit for salaries paid to an employee who had COVID and was not able to work? Okay, so salaries paid to an employee who had COVID, that is not an ERC credit. That is a credit under the Families First Coronavirus Response Act. That's the FFCRA that I was talking to you about. And basically you just allocate, you pull out those wages, you document that they were paid to an employee who did have COVID, or they were taking care of someone who had COVID, whatever, wasn't able to work. As long as you continue to pay them, you isolate those wages, that gets claimed on your 941. Okay, and you should be claiming that as you go. If by chance you did not, you forgot to, you can go back also and amend for the FFCRA a 941, but that's completely separate from the employee retention credit. Okay, the second question is, if a small employer is acquired by a group in Q 2021. Okay, there are rules on this. If you go to the IRS FAQ that I have a link to, it talks about acquisitions, and it talks about what happens when this scenario that you're referencing, where you had a business that by itself was small, but now they're part of a large. Go to that IRS FAQ, and I think it's going to answer your question on that. I don't know the answer offhand. I just know that I've seen that on the FAQ. Okay, so Faith, so I think we effectively overwhelmed everyone so that there's not any questions.
Oh,
good, there's more. Okay, we're a small manufacturer and reduced output because of problems receiving supplies needed for production. Some consultant websites indicate we can be considered a partial shutdown because of these supply shortages. Okay, so if you go to IRS notice 2020- something, I don't know, there is a separate section on whether or not your suppliers were shut down. There are very specific rules on that. So you would have to document that your supplier was shut down. So you'd have to have information from that supplier on why they were shut down. And then you have to document that you actively sought a replacement. So, if supplier A was shut down, you have to document, I went to supplier B, C, and D, and none of them could give me what I needed, okay? Then you would potentially qualify as that partial shutdown. If you went to supplier B and they gave you what you needed, I don't think you qualify. But there are a lot of documentation rules on that supplier rule, and that's in the IRS notice. And I think it's 2020-49, I don't know. If you Google ERC IRS notice, there's 3 of them that'll pop up. And one of them has that in there. Oh, that's my favorite. Randall Phillips, you and I think alike. How long are they estimating for the Reach Fund check for amended 941s? So this is the bad news, okay? You can Google IRS mission critical, and it will take you to a webpage on the IRS website that basically tells you the sad story of how far behind the IRS is. Okay, and it talks about business returns, individual returns, all this stuff. When I looked at it 2 weeks ago, it said they still had a million, at least a million original 941s that had not been processed yet. And those are going to be ones that small businesses are filing in paper, because we're talking about paper here. So there's a million 941s from 2020, 2021 that they're behind on, that they haven't even processed yet. Then somewhere else, they have a huge stack of like 300,000 amended 941s, but they cannot, or they will not process those until they get the million and change of original 941s filed, right? Because of the ordering, what if there's an amended one in this stack that relates to an original one filed here? So when I saw that, and honestly, I've been watching those stats, and unfortunately they haven't changed in 3 months. I'm thinking 2022. It's like, I tell my clients, here's your forms, please file them, certified receipt requested, so you know for sure the IRS got them, but don't book your trip to Cabo, because the money's not coming anytime soon. The IRS freely admits that. I think, Faith, you guys had the IRS lady on a month or so ago. She's on one of the webinars, and I posted this exact question in the Q&A. And that's when I learned about the mission critical. And even she's like, we don't know. how long that's going to take. So anyway, that's the bad news. I try to leave that off the slides, but thanks for bringing that up because it's very important. Okay, last one. I know it's 12:01. We'll do the last question, Faith. Is that all right?
That's great.
Okay, if a hotel was not ordered a business shutdown or reduction, but obviously significantly impacted, can we still go through the testing and see if we're eligible? Your best shot is the gross receipts test, okay, because you were not ordered to shut down. Here's a different example. Auto repair shops. Okay, auto repair shops were specifically deemed essential, right? You do not have to shut down. You can continue to operate at full operations. Well, what happened? They had less business. Why? Nobody was going anywhere. So that auto repair shop, and this example is actually in the IRS notice. The auto repair shop is not eligible on a partial shutdown because their business reduction was not related to a government order. It was related to the effects of the pandemic itself. So I think that's a pretty good analogy. And so your shot is going to be by using the gross receipts test. Okay, we answered all the questions. I'm going to turn it back over to Faye.
Excellent. Thank you so much, Carrie Ann. I always appreciate you breaking down these huge topics so they're a little bit more digestible for those of us who have a hard time with math. So thank you so much for your time and your effort this morning. And thank you all for joining us. I hope you all have a great Labor Day weekend and hope to see you here next Tuesday at 9 a.m. So thank you again, Carrie Ann. It's always a pleasure. And I hope you all have a great weekend. Thanks for joining us today.
Thanks, Faith.